Okay, that should take care of that. There we go. Okay, so welcome everyone to today's session on, well, the pros and cons of social responsible investing. All right, I'm just double checking. Okay, perfect. No feedback. Excellent. So yeah, so today we will be talking about kind of the pros and cons in social responsible investing. First of all, obviously, I'll be defining what social responsible investing is. And again, as usual, just a quick reminder, I don't hold any official certification as a financial planner or advisor. So the examples provided today will be for information purposes only and do not constitute investment advice. All right, so now that that is out of the way, what is social responsible investing? Well, again, it's an investment strategy looking at some form of social or environmental benefit or good. So they're really looking at kind of the greater good, right? So it sounds kind of the ideal investment for someone that has, that really wants to do good in the world. Now, if it was all only benefits, or if there were only pros and absolutely no cons to this investment strategy, you would probably expect that, most people in the grand scheme of things, they probably, see themselves as individuals that want to do good in the world, and probably people that actually want to, try to make the world a better place, right? Pretty much every single startup out there has something along the lines of they're trying to make the world a better place, a more connected place, a better place, more ethical place, etc., etc., etc. So if you think about that, you might think, well, obviously I should just invest in any startup. Like that sounds like they're in line with being socially responsible, trying to help their communities, and so on and so forth. And in many cases, that might actually be one outlet to do some form of social responsible investing. Now, that being said, however, there are many different tiers and different levels. And what one person might consider socially responsible, somebody else might say, yeah, I guess that company is sort of, they're doing right by their communities and whatnot, but in the grand scheme of things, they should also do X, Y, and Z, and they're not really doing those last two or three things. Therefore, it's not really the right company for me. So again, it all depends on how intense of a socially responsible investment strategy that you want to have. And again, for some people, social causes might be more important than environmental ones, and for some people, it might be the reverse. And other people might say, you know what, I'm only going to invest in companies that are both good for the environment and clean tech companies, renewables, things like that, but that also have very good kind of PR departments that not just tell you about all the good things that they do, but they actually believe, they have an ethos in the company itself, that they actually believe that they're responsible for helping the communities that they have their businesses in, or offices in, and so on and so forth. So it really comes down to what are really your values and how far do you want to push these. And obviously the downside, if you're of being someone that has a very specific, peculiar definition of what is acceptable, you will have that many fewer investment options available to you. Now, this doesn't mean it cannot work. It just means that you would have to do a bit more research and look into it. So let's see exactly what are some of these subcategories. So one of the I guess the more popular subsection or subcategory of social responsible investing is something called impact investing. So it's all about what is the impact that those particular companies and businesses you're investing in, what impact do they have on, again, local kind of, so local in terms of their own neighborhoods and cities that they're headquartered in, and that they do business in, but also on the, if you're looking at the state or provincial level, and also national and even global level. So to what extent do you want the companies not just to advertise and say that, oh, we want to make the world a better place, and we believe that there should be equity, there should be, everyone should be treated equally, we're going, global warming is an important issue, we should try to pollute as little as possible. Okay, it's great to talk the talk, but at the end of the day, when all those lovely PR notes are being sent and all those ads, after all those ads aired, what is the end result? What is the actual impact that company has on again local as well as national environment. So, but basically both the environment, the social environment, but also the environment itself. And again, other people really focus on just companies that are really good for the environment, or at the very least, they'll invest in anything that isn't detrimental to the environment, or if some companies are slightly detrimental, there are various ways of basically buying back certain carbon credits and other forms of credits, if you will, right? So some companies might say, you know what, our business model is such that, you know, we're dealing in an industry and we're essential. We have to create a certain, let's say, if you're looking at a company that creates fertilizer, for instance, right? When you're creating various fertilizers, I mean, yes, there are some that are worse for the environment and some that are better for the environment, but even the ones that are better for the environment are not all 100% eco-friendly, shall we say, and there are certain processes that will produce a certain amount of pollution, no matter how much the company wants to limit their pollution. Just the reality of things, right? You have to get certain materials, certain basic elements from certain rocks. You have to mine it, or you have to get it via various from various petrochemicals, etc., etc., etc. So if you're looking at potash, or if you're looking at basically various animal waste byproducts that you need to process in order to turn them into usable fertilizer, collect the nitrogen. You're using the Haber-Bosch process, for instance. Again, just hanging around with the fertilizer example here, right? So even if a company is really trying and really aims at having kind of as little as of a negative environmental impact, because of the business they're in, unless they completely switch their business, there are some amount of pollution that is inevitable, right? So in those cases, those companies might say, you know what, we're operating above and beyond industry best practices. However, there's still this amount of pollution we're creating, which is simply impossible to not create if you're in our business. And as a result, because of this, we will be paying a certain amount of money to basically buy these carbon offsets or buy some other form of environmental credits. And if on top of that, that particular company has a very stringent, anti-discrimination policy and has a very stringent policy where they're trying to, source locally whenever they're for their various procedures, as a result, further limiting the amount of greenhouse gases that are being created in shipping all of the different products or all the different items that they need to create whatever it is that they're creating, that might be something of great interest to people. Now, the downside, again, of wanting to invest in these types of companies is that you really have to do your own research, because many companies try to pretend or try to advocate for social responsibility and try to paint a picture of themselves as being very equitable companies and being very environmentally friendly. And to their credit, they're probably operating currently much, at a much higher level, or they're trying to, they're actually being a lot more environmentally friendly and socially responsible than many of their peers in that particular industry, and maybe even compared to the same company, 5, 6, 10, 20 years ago, right? So by all means, it doesn't mean that they're just pretending. It's just in certain cases, there might still be quite a bit of a lag between the image that they're trying to portray about the company and what the company actually does. A very simple example is if you're looking at a number of pretty much all the large oil producing companies. As you might have guessed, oil producing companies are typically a big no-no or a no-go, if you will, if you're trying to have a socially / environmentally friendly portfolio, because again, they do produce a lot of waste and a lot of pollution by the sheer nature of what they're doing. Now, that being said, every single one of the large companies, of the large oil companies, within the last 15 to 20 years, you can Google it yourself, or go on YouTube. I guarantee you, you can find at least a handful of ads from each one of the large companies, Shell, Suncor, BP, etc., that they were Imperial Oil, that they're basically saying, or Esso, and so on and so forth. They're going to be saying, look, we're we're investing this many millions dollars in renewable energy. We're investing this much in wind. We're investing this much in solar, and so on and so forth. So even the oil companies, which are by definition big polluters, have started looking at more socially and environmentally responsible way of generating their profits, of generating electricity, of generating their revenues. If you're looking at things, for instance, ethanol, right? So they're producing bioethanol, biofuels from things like such as corn. Now there are some interesting downsides of actually doing that. You might think, well, that's great because they're moving away from oil and they're using this renewable resource, which is corn, and they'll be basically producing this ethanol from the corn fiber, etc. Now, there are different subtypes of corn. Some are more environmentally friendly than others. So depending on which procedure are you using when you're collecting the fiber from the corn to produce ethanol, bioethanol out of that, and obviously run cars or industry out of it, the energy density within ethanol itself is significantly lower than that of gas, of oil. And if you think of all the fertilizers that need to be used to basically to grow said corn, if you're thinking of the fuel that is being used by the machinery to plant the corn, then spray it with fertilizer, spray it with maybe some antifungal or what have you, depending on where you're growing it. And then finally harvesting it and tilling the land and all of this. Once you factor in all of that and the fact that bioethanol actually has significantly less energy density compared to gas, you're starting to realize that in many instances, bioethanol might not necessarily be, at least for certain types of corn, might actually be almost as polluting as regular gas. But it looks very good on a particular company. So the reason I'm telling you this story is not to try to tell you that there's no point in social responsible investing or you shouldn't be doing it. It's just that if that is something that you truly have at heart, it is really your prerogative to look into, unfortunately for now anyway, each one of the companies you might be interested in investing in, and really looking at, okay, why is this considered a socially responsible investment? Why is this considered a socially responsible company? Because obviously there are ETFs, and there are a growing number of ETFs that are considered SRI, so socially responsible investing ETFs. And there's virtually a new one every month that comes up, and we'll talk about two specific ones in a little bit. But just because a company or a set number of companies are part of that ETF doesn't necessarily mean that they're in line with every single thing. Now, that being said, unless you're someone that is incredibly hardcore about social responsible investing, and you have 20 different check marks that every single company has to abide by, in those cases, most of those ETFs are perfectly fine. I'm just trying to tell you that it's one thing when you're investing out of principle, right? So you're investing only in things that truly benefit society and the environment, versus investing because it's a nice thing to do and it makes you feel nice and fuzzy on the inside, right? So you're telling yourself, I'm investing in this because I think that it's the right thing to do. And you might truly believe that, but it also makes you feel good because you're not contributing to the problem. Now, that being said, there's nothing wrong with doing that. It's just that if you're in the latter category, just be aware that many of those ETFs, if all you're doing is you're just picking an ETF, some of the companies that they're holding are not 100% or not truly socially responsible or environmentally responsible, or they're barely any better than some of the big polluters out there once you start really looking at it all. Again, I'm not trying to discourage you to do this. I'm just trying to kind of, because I guarantee you, if you Google it, you'll see quite a few articles kind of trying to debunk social responsible investing as a hoax and as a fraud. Well, no, it's not really a hoax or a fraud. It's just you have to understand that depends on what your definition is. What do you consider socially responsible? What do you consider a company that is a good company for the environment and for the people? Because unfortunately, this is a reality we're living in. A lot of companies have excellent marketing and PR departments, and while they will try to do better and will do better than a previous version of said the same company or maybe some of their competitors in that same field that same year, in the grand scheme of things, they might not be quite as socially responsible as they might advertise or as someone might think. So the only reason I'm saying this, I'm not trying to discourage you against socially responsible investing. I'm just trying to point these things out so you're not under the impression that you can just pick any random ETF and every single company in there is 100% vetted to be 100% socially responsible. So it really depends on your definition. What do you consider socially responsible? What is right for you? Because otherwise you might, 5, 6, 10 years down the line, you might realize that, oh my God, I had this portfolio. And we'll talk about some of the potential negatives of social responsible investing, which is you have slightly fewer options, etc. So then you might take on the negatives, which are slightly lower rates of return or slightly higher risk because you're concentrating your holdings in fewer companies in fewer global regions. And then if on top of that, the actual investments, the underlying investments are not really quite what you had hoped or what had been advertised to you, then you will feel kind of very much disappointed and kind of lied to, really, because you're some people might say, you know what, I'm okay with a 5.5 or a 6% annual rate of return instead of a 7 or 7.5, right? So you might willingly, consciously take a 1% hit or 1.5% lower rate of return, but provided you're investing in the right companies, right? It's just, I don't want you to be in a position where you're taking that lower return hit, yet once everything is said and done, it was just clever marketing and the difference is minimal, if any, right? So this is just something to keep in mind. So it's important to research those specific ETFs. And again, probably in late August, I'll have a 15-minute video detailing up the top 5 SRI ETFs that are kind of better at this. And hope by then there's another couple of there's another few weeks, so maybe another 1 or 2 of them will emerge by then that I can review as well. Anyway, so social responsible investing really at its core focuses on sustainable and equitable businesses. So businesses that are not sustainable and equitable, so basically businesses that are just trying to profit and just kind of the savage capitalism model where basically all you're doing is minimize cost as much as possible, pay people the bare minimum that you can legally get by with, with the environment. Who cares about the environment? We'll just pay a fine if we're caught kind of polluting, and it's just the cost of doing business. So obviously those companies would definitely not be part of your of an SRI portfolio. And I'm not saying that it's necessarily every single other company out there that isn't officially an SRI company will necessarily do that all the time, but there are certain stories of various companies behaving in very unique ways, shall we say. And sometimes companies that you might perceive as being really forward-thinking companies, at times not that long ago, or sometimes even concurrently in some other parts of the world, might be, shall we say, behaving very unethically. So again, I don't want to pick on specific companies, but I guess just one example, so I'm not being too vague. After this, so in like 40 minutes from now when I'm done talking, Google Nestle formula. So just to give you the heads up in case you don't know the story. So Nestle, right? They're a massive multinational. Obviously, they're a Swiss company, and they own hundreds of different brands, and certain brands that they own in certain parts of the world. They're not necessarily in North America, and some are only in Asia, and some are only in Africa or only in Europe, etc. So now, overall, if you're looking at Nestle as an overall company, yes, they have various social responsible kind of equitable plans, and they're really trying to be very equitable and very fair to their employees, etc. But if you're looking at some of their business practices from, let's say, 10, 15 years ago, and in certain cases, some of those same business practices are still ongoing, it might leave a relatively bitter taste in your mouth. So the formula debacle I'm talking about is obviously, you might be aware, or might not be aware, I don't know, that, groundwater is a relatively limited commodity, globally speaking. Now, in Canada, that sounds a bit ridiculous because obviously we have water everywhere. Now, Canada also has a ridiculously large percentage of the world's drinking water. So those of you that might be from, let's say, certain Asian countries or certain Middle Eastern countries where there is a significant, or African countries where there is a significant scarcity of water, you know exactly what I'm talking about when I'm saying that water is not such a easy to come by commodity, or clean drinking water specifically, not just water in general. So for the last probably about 20 years or so, Nestle, as well as other companies, not just Nestle itself, have been buying more and more of the world's freshwater aquifers, as well as freshwater resources. So they might be buying off the water extraction rights to a lake or to groundwater and things like that. And then you have issues where basically just last year or 2 years ago, when there were the large fires in California, farmers were not allowed to water their fields because obviously there was a massive drought and ongoing forest fires and brush fires. Yet Nestle was still pumping out, millions and millions of gallons of water out of the groundwater to sell in bottled water, right? So that's a whole kind of push, that McGill and other universities have had to kind of against bottled water recently. But so it's not just that. Nestle also makes and owns many different subsidiaries that make a number of things, including baby formula. So one of the and this is, again, it's a relatively old story. It's probably about 20 years old or so at this point. So what they used to do, and probably have also done a bit more recently than 20 years ago, but that was when this story came out, is that in sub-Saharan Africa, so relatively poor nations such as Ethiopia and others, they would basically give free formula to mothers that would have newborns, right? So they would give them formula for free. Right, so that sounds, oh my God, that's a great thing. Like, why are you trying to badmouth Nestle? So we would just give them formula. Now the problem is, if you're a mother and you switch your baby to formula, because again they had some issues with malnutrition and whatnot, you're switching your baby to formula, especially if your diet is significantly lowered, your milk production will pretty much go away as long as you're provided with formula for a couple of months. So guess what? Nestle would provide them with free formula for about 3 months or thereabouts, and afterwards, once the mother's no longer actually producing any milk for the baby, they basically say, well, now you have to start paying for it. And not only that, now the formula you cannot just give powder formula to infants, right? They'll choke on it. So you need to do what? Well, you need fresh water, you need clean drinking water to dilute the formula in. Guess who also provided the water that at this point had to be paid for? So Nestle was selling both water and formula to some of these third world nations. Now, again, that's just one incident, but my point is, it really depends on what your values are. So it's important to research those companies. And again, that was 10, 15, 20, 30, I don't remember for how long this has been going on. This came out, I think, in the late 90s as the story at first time. And I've seen something come up again in the early 2000s as well about this still being a thing, unfortunately, in certain parts of the world. So the key point here, the main takeaway is that you can argue that, that was then and this is now. It's just, if you're taking this to heart, don't only look at what the PR department is saying. Look into it a little bit further if this is truly something that you're interested in, instead of just buying an ETF that holds SRI companies. Because by many other metrics, Nestle and others might be considered, and as a matter of fact, are part of certain SRI ETFs out there. Not every single one of them, but are part of certain ones. All right. So as I said, just Google this for yourself and look into what I was talking about. This is sort of a very brief, summarized version of the complete full story. Okay. And as with most summaries, if you're missing some of the detail, you might, once you have the detail, you might make, you might come to different conclusions. Anyway. So again, I already mentioned this, but yeah, so they avoid basically investing in things such as oil for obvious reasons, military equipment producers, so in your Lockheed Martin and Raytheon and things like that. Other large industry polluters, so typically large chemical companies like DuPont, for instance, and things like that would not necessarily be sought after. And then finally, if you're also looking at, you would probably be avoiding sin industries. So the sin industries are literally what was historically, and maybe even to this day and age, depending on your culture, your background, what is considered a sin. So for instance, they would avoid things such as, any form of drugs, so any marijuana companies and things like that, legal drugs, I should say. They would probably also avoid any form of cigarette companies, any alcohol producers, again, weapons producers, but that goes with the whole military aspect, as well as gambling companies, porn companies, and things like that, right? So all sin industries are typically also excluded from social responsible investing. Now, specifically here, now it's quite interesting because this is sort of the history of the social responsible investing. If you're here, I'm just going to put this in the chat. There you go. So the really interesting bit here is that you have sort of the very first social responsible company, if you will, sort of came about back in the 1750s. And the idea there was, it was really the Quakers, this religious society, that they basically decided that all of their members, in order to remain a member, you were not allowed to participate in the slave trade. So you weren't allowed to buy or sell humans. So this was in the 1750s in the US. And so this was sort of this is kind of historically the first incidence of social responsible investing. So if you were to be part of the group and take advantage of some of the services they provided, you were not allowed to have basically slaves, which is I think it's a very, very good practice to abide by. Not selling humans. So you can read a little bit more about this if you want to see kind of the whole sort of history of social responsible investing. I'm not going to be boring you with the details, but it's quite interesting to see how over time what's considered social responsible investing has changed. Initially, again, it was all about the basic human decency and considering not owning other humans was sort of the bare minimum, and then you started looking at more and more. Okay, well, how can we help the environment? How can we help various social causes? And then those would be some of those champions in those industries, in those particular companies. So a really interesting subsection here talking about the history of social responsible investing. I'd highly recommend you have a look at it. All right, so what are some of the pros and cons? Well, again, quite a few of these I've already mentioned. So some of the pros, well, again, it allows you to invest in line with your beliefs, right? So it's incredibly important for you yourself to kind of sort of be a bit, kind of take a look or, a step back and really ask yourself, what is truly important to me, right? What matters? What would I feel okay investing in? Right? Because again, there are different levels. There's how hardcore do you want to be of a social responsible investment? Is it companies that are right now doing the right things? Will it bother you if, like with my Nestle example, and that's just one thing that they've done, in the not so distant past? Would that be an issue? Again, look it up in more detail to see if they're still doing it or not. That's all. I'll leave it at that. would that be considered a no-go for you? And then obviously, whenever you're looking at an ETF, make sure that the companies that are part of that ETF are companies that abide by those principles, right? So that way, if you are going to take slightly higher risk because you're consolidating your investments into slightly fewer companies, you want to make sure that at the very least they're in line with what your beliefs actually are. And as I said, you can be as stringent or as lax about this as you want. Different people have different values, and that's perfectly fine. I just don't want you to lower your returns on purpose because you think you're doing the right thing, and you're only investing in social responsible companies by your definition. Yet the definition that particular ETF uses is a lot more lax. Okay, so just because you're buying an ETF that is supposed to be SRI, depending on what your own definition, on your own kind of guiding principles are, it may or may not be in line with what you're looking at, okay, or what you would like to invest in. So again, another pro is that you can have a positive impact on people in the environment. So even if it's only a small impact, it's still better than not, right? So as I was saying before, you can be very stringent. You can say, you know what, I'm only investing in clean tech companies that produce 0.1% pollution compared to everybody else, right? Like everybody else produces 99.9 and they're only producing 0.1 or some ridiculous thing like that, right? Or you can be like, as long as they're producing slightly less pollution than the industry average, that's okay for me. Because yes, you cannot just change everything overnight. So depending on which camp you stand in, you may have an easier or harder time finding the investment that actually works for you. And again, long term, the more people that are investing in one level or another of these social responsible companies and industries, it really does send a long-term message to companies that this is what people are interested in, and this is like a good way to appear in the public's eyes. Now, I want to remind you that 99.999% of transactions occur in the secondary market. So, there's a IPO, right? IPO. That's the initial public offering. That's basically the first time. So it's the first time a stock is sold to the public, right? So this, if you're looking at the number of trades that happen there, it's probably, without exaggeration, it's basically 0.000000001 without exaggeration percent of all trades, okay, of any company. It's something along those lines, right? The vast majority of it, especially when you're looking at a company that has been on the trading for a few decades, the vast majority is between different investors. The reason I'm pointing this out is because a lot of people think that whenever they're investing in a company, and especially when they're investing in socially responsible companies, they're giving the money directly to the company. The only other time, other than the IPO, that you're giving your money to a company directly is if, for whatever reason, they're basically issuing an addendum to their prospectus, and they need to raise additional funds. So they might actually issue additional shares, therefore diluting the value of each other additional share. But again, most cases when they're doing this, in the vast majority of cases, it's still the large players, still the large pension funds, it's still the large banks that typically buy directly from the company, and then everybody else buys it from them. Some of the exceptions are smaller companies or even large companies, such as, if you're looking at some of the auto manufacturers, for instance, BMW, that trade OTC, that trade over the counter, right? In some of those instances, you might actually, technically speaking, buy directly from the company whenever you're buying some of their shares. But in the vast majority of cases, again, 99.9999% of the time, you will typically be buying your shares from somebody else that isn't the company itself. The reason this is an important distinction to keep in mind, and again, this is not only for socially responsible investing, but this is true for everything. Whenever you're buying an individual stock or you're buying an ETF, you're not directly giving the money to the company. If you were directly giving the money to the company, that would send an even stronger message that you really are only interested in buying shares or becoming co-owner of a company that is socially responsible, that is being treating people fairly, not being racist, etc., 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 and that is also good for the environment, right, and equitable and whatnot. So in those instances, right, you would that would be a very, very clear message. Now, that's not how stocks work. That's not how ETFs work, right? As I said, 99.999% of the time, you will be buying it from somebody else that held it, and maybe that person bought it from somebody else that held it for a certain amount of time, and so on and so forth. You might be the nth, we don't know, 100th owner of those shares. But nonetheless, it still shows, demand or lack thereof for their stock, and as a result, that will have an impact on share prices. Not as dramatically as when a company absolutely needs to raise some funds in order to secure some debt or whatever, or to be able to function. But it still does send a message. Again, I just wanted to point this out because, again, some people that aren't as familiar with investing might think that, whenever you're buying a stock or an ETF, you're directly giving the money to the company, which is not really the case, right? Anyway, so as I was saying, so long term, it does send a message to companies, even though you're technically buying it from somebody who already bought it, because you can just see the overall demand. What are some of the cons? Well, again, there's increased risk, right? Because you're on purpose ignoring or avoiding certain sectors, sometimes whole industries, sometimes specific companies, sometimes whole countries. If for instance, if companies in certain countries have a very bad human rights track record, for example, if certain companies are very xenophobic, or they're very again, whatever is a part of your beliefs and whatever you're interested in investing versus not investing in. So if they're not abiding or not checking those check marks that you had, well, in that case, you stay away from that entire sector, that entire country, or that entire, sub-industry, which, if it happens to be a very profitable industry, obviously will lower the overall rate of return of your stocks, right? Furthermore, so lower return, but you also have a higher risk because, again, you're more concentrated in a handful of industries. So certain things that might not impact some of the other industries you're on purpose not investing in might impact your specific industry more. As a result, again, higher risk. So as I was saying, so not all ETFs are fully SRI, and there are very different levels. So even if they are technically speaking socially responsible, and they're only dealing with socially responsible companies, there are, again, very different levels. It's incredibly important to, again, look yourself in the mirror and ask yourself, okay, what is incredibly important for me when it comes to my beliefs that I invest in? And what's something that I would like to see a company do, but if they don't fully do it just yet, I'm still okay just because they're still the best one out of that entire industry, or they're the best one out of similar comparable companies. So they might not be perfect, but I'm okay with that because they're still a lot better than everybody else, right? Whereas other people would say, no, unless they're doing this, and this, then I'm not investing in them. So again, that's a personal choice. Just realize the more picky you are, the more concentrated your investments. As a result, the higher the risk, the less diversified you will be, and potentially the more you can long-term underperform the average market rate of return. Okay, unless you get lucky and those particular companies do really, really, really well. But again, typically you'll have much higher risk as a result of those choices. Now, just very quickly, so this is just a very quick example that I want to show you here. So this link is simply just looking at Wealthsimple. The reason I'm pointing Wealthsimple out is because that's a robo-advisor, and they do have a number of robo-advisors out there do feature social responsible, and here's the link, social responsible investing alternatives. And the really cool thing is, just over a month ago, they've come up with 2 brand new ETFs that you can invest in. So you don't have to go and open an account with Wealthsimple and have them manage your own money. You can actually buy those specific ETFs yourself. So So that's kind of really cool. And again, I will be reviewing those two ETFs in a future short video coming up in about a month or so. So let's say what you're looking at. You want to go with a fully balanced portfolio, so your standard 60-40. So in this case, it would be, these are the ETFs, and again, because they are listed on the Toronto Stock Exchange, their tickers are WSRI.TO and WSRD.TO. So this is North America. So these are socially responsible companies in North America, and these are socially responsible companies in developed markets globally. So they look at Europe, Asia, again, the Asian developed markets specifically. So you're looking at Japan mostly. You're looking at a few other, Korea, and so on and so forth. And then some Canadian government bonds here to kind of make up the bond component, obviously, of that. So that's kind of interesting to look at there. Now I'll come back to this in a second. All right. So what are some of the solutions to some of these challenges that we've been talking about? Well, again, to guarantee that every investment is 100% SRI, you can buy and SRI, and again, specifically your definition, your own version of SRI, your own version of what you consider socially responsible investing. One option would be to buy individually. Now, again, this is typically not advisable for most people, just because, again, you're increasing risk. Depending on who your brokerage is, you might end up having to pay slightly higher fees. Many brokerages these days offer free buying of ETFs, but not of stocks. Some offer free buying and selling of both ETFs and stocks. But again, that might be slightly more fees and definitely more trading, right? If you're buying individually, in order to have a balanced, diversified portfolio, you probably would need about 15 to 20 different stocks or thereabouts if you buy them individually. But the positive of that is obviously at that point, if you do take the time to research every single one of those companies properly, you will at least be aware and be certain that as long as the company policy doesn't change, you are investing in something that you truly believe in, right? So it might be something to consider. Now, there are some alternatives to this, right? So one of the alternatives is to expand your definition of social responsible investing and what is acceptable to you. And as I said, I'm not trying to say stay away from social responsible investing. It's just if you're being the more specific you're being, the more stringent your definition, well, unfortunately, the fewer options you have available. So if you don't have the time, knowledge, and knowledge to set up a balanced, diversified portfolio by buying individual stocks, a decent compromise would be to go with one of the larger SRI ETFs. They might not be perfect because, as I said, quite a few of them are actually, they're companies that are socially responsible, but not by everyone's definition. And there might still be, in many of those ETFs, there's still some oil companies held within them. And you might be thinking, well, how on earth do oil companies make the cut? Well, because they're selecting from all the large oil producers in the world, they'll select one or two of them that have the most social programs, that are the most equitable, that have demonstrated that they're expanding their renewable energy sector and so on and so forth, that have been actively trying to use industry best practice or even go beyond industry best practices to eliminate or limit the amount of pollution that they're producing. So again, you could still invest in oil companies as long as you're fine with that sort of slightly expanded definition of what is considered socially responsible, right? And so just to make it very, very clear one more time, a lot of ETFs consider that to be socially responsible enough. So quite a few ETFs will still have, that are labeled as SRI ETFs, will still have certain oil companies or other industries that many other people might that have a more narrow definition of what is socially responsible investing might not consider socially responsible enough. Okay, so just make sure you understand those things. If you're fine with having some of those, then it will be a lot easier for you to have a socially responsible investing portfolio and for it to be decently balanced. So again, thoroughly research available ETFs. Now, for this, you can use just the Morningstar. I should have included a link here. I've covered this on a couple of occasions previously. Let me just. You can use this ETF Screener. There we go. Well, it's having a moment. As soon as this loads, I'm just going to copy the link in the chat, and then I'll also the 3 links that I've provided you in the chat, I'll make sure to include them in the description of this. Okay, I'm not sure why it's okay. It's just taking a little bit of time. It's a bit laggy. All right. Okay, that should work. That seems to work. So here you go. That's a rather lengthy link. Oh no, sorry. The link is too okay. The link is too long for the. Let me see if I can find a shorter version of this. Morningstar.ca. Let's just do it this way. Or it might help if I knew how to spell. There we go. All right, so we're gonna go to the Canadian one. And now we're gonna go to okay, their website is having a moment today. As you can see, it's not supposed to normally jiggle around like that. Okay, so you see you literally have a sustainability tab here. Okay.
Recently, Sustainalytics released the first report in the new portfolio research series about where investors can get the biggest ESG bang for buck as they navigate the COVID-19 market recovery. Sustainalytics applies an ESG at a reasonable price score that helps investors find stocks with low levels of ESG risk that also trade at a relatively low price to earnings ratio. Doug Morrow, Director and Head of Portfolio Research at Sustainalytics, is here today to talk about the report and the findings. Doug, thank you so much for being with us today.
Into its biggest sustainable.
You're welcome. We're happy to be here.
Fund. So,
what is ESG at a reasonable price? How exactly does this metric work?
Okay, not sure why it's.
Yeah. So, as you mentioned, really, what the metric is designed to do is to investors identify precisely what you said in other markets where they can get the biggest ESG bang for their buck. So we came up with it. So ESG GARP, it's a portmanteau of ESG and ESG risk, and obviously growth at a reasonable price, or GARP, investment strategy. And essentially what we do is we calculate these scores by looking at the one hand ESG risk levels among companies in different markets around the world. And then we also, at the same time, look at how expensive these companies are relative to their same sector global peers from a PE perspective. So the higher a ESG GARP score, it means the greater the likelihood that an investor can find stocks in that market that have a good ESG risk profile, but also trade at reasonable valuations.
So how would an investor be able to identify ESG leaders from their response to the overall COVID-19 pandemic?
Social responsible investing. And
yeah, I mean, the scores themselves, the ESG GARP scores, are driven by Sustainalytics ESG risk rating scores. So obviously they're not centered explicitly around COVID-19. It's a much broader measure that takes.
They also talk about a few myths over here. So I would say, have a look through this. This is just, today's session was really more of just kind of an introduction to this. So here's a list of them. So I'm trying to remember. Yeah. So this is also April this year. So it's not that old, basically. So you can see that there's more and more sustainable ETFs that are emerging. You can see they're in red here. So these are how many new ones have been launched. So these days it's pretty much 1 to 2 a month, right? So every single month you get a couple of new ones that are sustainable ones. And you can also look at, some are emerging markets, some looking at the total market. And quite a few of them are from iShares. So again, those of you that have attended previous sessions, you know I'm a big fan of the iShares ETFs as well as the Vanguard ETFs because they're very, very large ETFs. So you're a lot less likely for them to become illiquid or not being able to get rid of them if you need to sell them at some point or another. So these would be some of the ones you probably want to consider. So I'm going to just post this link over there as well. There you go. So here you go. So this is really just an intro, as I said. So have a look and see what you like. I will be reviewing about, I think, 4 of these, if memory serves, as well as the 2 new ones that have come up from Wealthsimple recently. So here are the 2 specific ones from Wealthsimple. So WSRI is here. And then the second one, so you can see that is basically, it's been around literally a month ago. So on the 17th of June, this thing has launched, and obviously today we're the 16th of July. So yeah, it's been just a month. So the downside of this is obviously you don't really have a decent amount of history to really relate to how this particular ETF is doing. But I would say, have a look at this one as well. And again, and then the second one here is so that's just North America. And this other one, WSRD, this is for developed markets worldwide, except for, again, North America. Okay, so they're kind of combined. So the previous one would be kind of your US Canada exposure, and now this one would be your international exposure. So if you're looking at US Canada and you're looking at a standard 60-40 portfolio, you probably want about 40% exposure or thereabouts to the US Canada one, and about 20% exposure to this one. And then for the bonds, that's pretty easy. Just pick any standard ETF that has bonds. Again, this is just information, not financial advice, but that would be another way. So if you're going with a standard 60-40 split, right? 60-40 split, then the 40, that's your bonds. So there's a ton of bond ETFs out there. We've seen VAB.to, for example. That's just for bonds, or there's many other ones that you can look at, and these are .to, obviously, .to, and the 60 here. One easy way is just to split the 60 into 30-30, and that's specifically precisely what Wealthsimple is doing. But if you're using kind of the more standard approach of the 60-40, right? So the whole point is you have, in the 60-40, you have your, there we go. And okay, it's just, come on. It's being a bit finicky. Apologies for that. There you go. Stay. No. Oh my God. Okay. Okay, now it should work. Good. I think my tablet is battery is dying, so that's why it's not letting me click where I want to click. Anyway, so if you're looking at a standard diversified, balanced diversified portfolio, right? The sort of the basic portfolio for a Canadian would be 20% Canada, 20% US, 20% international, right? So if you're using that logic, WSRI basically makes up these two, right? So that's what it represents. And because of that should be roughly, right, 40%. And then this one is, technically speaking, international, so that would be 20%. Okay. Again, a perfectly fine approach. The way that is also just go 30-30 here and then 40 for bonds, because that's exactly what Wealthsimple themselves do. Okay. So if you just open an account with them and use their robo-advisor option, and you select the social responsible investing option, that's exactly what they're going to be doing. They're going to go 30% this one, 30% this one, 40% bonds. If you choose a balanced portfolio, if you choose something slightly riskier, then obviously the percentages might be a bit different. Okay. All right. So just to wrap up here. Social responsible investing allows you to basically grow your wealth while helping society and the environment. Just incredibly important to understand what is your own personal definition of social responsible investing, what is your own personal definition or concept of what is good for society, and make sure that whatever you're investing in is actually, in line with those things. Because otherwise, if you're just picking a random ETF, as you saw in the article from Vanguard, sometimes ETFs also change over time. So that Vanguard one, the social equity one, it might be in line with your beliefs right now, but over time it might change for the better or worse. So it's important to kind of keep up to date with what's going on. And again, depending on how stringent your definition of SRI is, you may be limiting yourself significantly. So that's a significant sort of downside of SRI investing. But it might very well be worth the cost, provided what you're selecting to invest in is actually in line with your beliefs, and you're not just limiting your options and still not doing what you thought you're doing, right, when it comes to investing. And again, in certain cases, you might be stuck picking individual stocks. Again, it's not ideal, especially if you're just starting out. I'd probably say, go with a robo-advisor, something that is fully managed for you in most cases. And again, I'll be going into the details about those 2 specific ETFs from Wealthsimple, as well as 4 of the ones listed in that article out of those 10 most common ones in Canada. So technically speaking, there's 6 of them. Although I think the title I was going to go with top, your top 5 SRI ETFs, and I'll be like, well, now that you watched the whole thing, there's an extra 6th one for you. So, but since you're here, there'll be 6 of them that I'm going to be reviewing. So keep doing your research as new SRI ETFs emerge each month. And a really great start is that Morningstar website I showed you, and that subsection of their website where they're talking about equitable and social responsible investing. So that's really what you want to be looking at. All right, so just in closing here, because that's pretty much it for my slides, let me just go back to this. So these sustainable investing ETFs. So I was trying to get to the ETF Screener. So ETF Screener right here. Because before it was doing something that wasn't supposed to be. So here's just because I wouldn't be able to load it before. Here's the link specifically for the screener itself. So here you'd literally be, if you don't want to just select those 10, if you want to kind of go through this, you can literally just select this option here. And it'll automatically just give you the sustainable ones as well as their highest rated 5-star ones. And there you go. And so 5-star management style fund. So typically you really, again, a good, I would say, ballpark is if you're aim for ETFs that have at least $500 million of assets under management. That way you avoid an ETF potentially shutting down. It's not guaranteed that it'll never shut down, but it's less likely to shut down if they have at least $5 million worth, $500 million in assets under management, right? Now, obviously, the downside of this is these are all bond ETFs. Okay, so let's try to select something maybe in the 100 to 500. Okay, so that gives us a little bit more, which is useful. You also want to look at the fees as usual. And let's just put this entire thing on 50. Here we go. Not useful that they're not mentioning the fees themselves, but oh well. And then, yes, you have risk over here, long-term performance. There we go. So you also want to see what the performance is like. But as usual, right, just because something has performed really well historically doesn't necessarily mean it'll continue to perform well going forward in the future. So where is the... Because it doesn't, for some reason, doesn't want... Again, their website is a bit way laggy today, so I'm not sure if that's why some of the links I'm clicking on are not loading or what's going on. But let me just try to find something XESG, right? So, so here we go. And now we want to go to products, continue. So you would have this XEN one, right? So social index. So just to give you an idea in terms of how big this one is. So this is on the smaller side, so $86 million. Personally, again, I usually, my preferred is 500 million or more, but you really want at least 100 million. Again, that's one of the downsides with SRIs, I guess. I should have mentioned that also before. A lot of them are relatively new. As a result, there's not quite as much money in them, but that amount is growing steadily, right? So what they're specifically invested in, this is a cool thing to know. You can go here. So there's 52 different companies. And again, the reason I'm pointing this out is I want to just show you what they're actually invested in, right? So this is considered, right, social index, exposure to Canadian companies that meet a broad set of environmental, social, governance, and rating criteria, can be used to invest based on your personal values, seeks to provide long-term capital growth by replacing blah, blah, okay? So far so good, right? Sounds like it has the word social in the index, right? But let's have a look at what it actually constitutes, this particular ETF, okay? So this particular ETF, here's the link to what I'm looking at right now, and this is the last thing I'll tell you. There we go. So this particular ETF here, so it has 52 different investments, right? So the first one is Shopify, okay, so 12.64%. Then Royal Bank, about 10%. Canadian National Railway, I'm like, okay. TD, Bell, BMO, Suncor Energy. Huh, interesting, isn't it? It's an oil company. And again, there's nothing wrong with wanting to invest in oil, provided that the reason that oil company is there is because Suncor has demonstrated that they're better, they're operating by industry best practices, yada, yada, yada. But again, if your definition of social responsible investing is to avoid oil at all costs, you probably don't want to be in this one. Same thing with Canadian Natural Resource Limited, right? So here, between these two, you have 3.7 versus plus 3.04. So that, those two combined are almost 7% of your investment. So almost 7 cents out of every dollar goes into the oil sector. If that's not something you're interested in, And then once you actually look at the whole thing, right, they're actually also investing in Cenovus, Imperial Oil, Keyera, ARC, Vermilion, etc., etc., etc. So if you were to add all of these up, and as a matter of fact, that they do that for us here, it's 10.89% is invested in energy, right? So that's 11 cents on the dollar is invested in energy. Which again, it's nothing wrong with wanting to invest a bit in energy as well. It's just that I want you to be very aware of the fact that just because an ETF is advertised and even has the word social or social responsible in the title, it may not necessarily be what you thought it is. Okay, so this is why it's important to look at what's actually contained and held inside of each one of these. Now, this actually I haven't checked before, so let's just sri.to. Right, I think that was WSRI. I thought that was the because I'm not sure if it actually has this one given. Oh, sorry, I should all of them. There we go. Because again, it's literally a month old only. Let me just WSRI. Because that would be nice to see. Wealthsimple. Actually, what was the official name? I wanna just I forgot to do this beforehand, so I'm literally finding out at the same time as you are whether this is actually gonna work or not. So Wealthsimple North American Socially Responsible Index. All right, so that's the name, and there we go. And no, because it's too new, we cannot really see it on the Morningstar website, which is too bad. There we go. I think this one should probably be it. Again, one of the other downsides when something is this new, there's not going to be a ton of data about it, which is too bad. But yeah, in August I'll be so this will be late August. I'm not sure exactly when. So I'll basically starting on August. What is the first day of August? First day of August, the first Monday of August, I should say. So August 3rd will be my first short video. So then basically Mondays, I'll have a 10 to 15 minute video every single Monday initially, probably August, September, and then starting in later in September, I'll have 2 to 3 a week. So there will be starting on August 3rd, Monday, August 3rd, first short video on that particular Monday, and then Thursdays I'll keep on doing my usual 1 hour-ish live stream. But yeah, so I'll be talking more about these in the very near term, basically, to see about that. Okay, so again, I hope I gave you at least a very basic introduction and understanding of what social responsible investing is all about, and how you should really look beyond simply what something is called. And in many ways, that's actually a very fitting metaphor, I think, for a lot of companies that pretend or say that they're being socially responsible, and then what they're saying versus what they're doing. And same thing with the ETFs that hold those companies. A lot of times they'll say, well, it's a socially responsible portfolio because they've picked only a handful of energy companies versus all of them, and the handful of energy companies that they picked, or a handful of maybe gun manufacturers that they picked, happen to be the most socially responsible out of the bunch. But is that really social responsible? It really depends on you, right? What is social responsibility to you, and what are your priorities? Anyway, so that's pretty much all for me for today. So thank you so much for taking the time to watch this, and if you're watching it later on, again, I'll make sure to copy all of the links that I posted in the chat, to copy them in the description of this video. So hope you enjoyed, found something useful, and I'll see you next week. Take care, everyone. Bye-bye.